Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Connor Campbell, who is a financial analyst at Spreadex. We're going to look at three stocks that are reporting this week. And we're going to start off with Dixons Carphone. I don't like the stock, regardless of what the market thinks. I just think they've got trouble ahead.
Yeah, it's hard to... just looking at the chart, you don't get charts much more ugly than that, really. You know, in mid-November, you can see those lows there. That was its all-time lows, so not good. Plus, it's in the retail sector that, probably heading for a pretty rough 2018, and it's in a specific part of the retail sector that, the fact that Dixons Carphone has done so well recently in terms of its financials, is constantly a surprise given that it's the kind of thing that could be wiped out by any online competition. Mm-hmm. But like I said, its figures hold up. They did, at least in June. Like its full year figures in June. 10% rise in full year pre-tax profit to £501 million. That was a record figure for the company. Like-for-like revenue was up 4%. Total revenue was up 3% to I think £10.5 billion. So that's, any way you cut it, those are some pretty healthy figures. Like-for-likes held up over the first quarter when they reported those in August. I think total like-for-like sales were up 6%. That's, again, very strong. I think most companies would take, at the moment, that kind of like-for-like growth easily. However, it did warn that for the full year, its pre-tax profit would be between 360 million and 440 million. Now that's a long way below that 500 million pounds it posted last year. However, I will say 360 million to 440 million for a retailer in the UK heading into a pretty rocky 2018 is not a bad figure, especially if it hit the top end of those estimates, 440 million. That's only 60 million less than its record figure, which isn't bad at all. However, as you can see, investors didn't take quite a positive view of that note. It plunged horrendously and it really hasn't begun to recover since. It's been creeping off of those lows. I think that's likely just people buying around those lows. In terms of its half-year figures on Wednesday, I think pre-tax profit is expected to fall something like 56% to 63 million. So that's not great, and that doesn't necessarily, I guess, puts it at the lower end of that previously stated 360 to 444 year target. Obviously, we're heading into Christmas. We've got the bigger period for the company coming up. I think in terms of how it does after Wednesday, I guess if you can beat that profit decline forecast, then you could see some positive movement there. If it's like-for-likes have held up for the second half as a whole, again, there might be some people willing to buy around that 160, 170 mark just because of how low it's fallen. And I guess what will be key is what kind of tone does it set heading into Christmas?
The guidance, yeah.
If it says, things have been a bit rough in the first half, but we're heading for a strong Christmas, we've got this and this. The only thing is, it has said the reason for that decline in profit is, interestingly, not necessarily to do with I guess it's partially to do with currency movements making phone handsets more expensive, but also it's each new generation of phones, the improvements are sort of incremental is the word that Dixons Carphone uses. People don't feel that fervour to go out and buy a new phone the moment one comes out because it's not leaps and bounds above of what they've got in their pockets already. So whether they can post, in terms of that, a better thing heading into the new year, I'm not sure. I guess there is stuff like the iPhone X, things that could drive them to a decent Christmas. But like I said, it really depends on the sentiment they outline on Wednesday. In terms of our clients, it's mixed, but also there are buyers around the 160, 170 mark. Just, I think, it hit all-time lows in mid-November. I think there are people fishing around to see if it has hit those lows and if there is room for, it can bounce back towards. Say if it had a really good few weeks, it could bounce back towards £2. That's still a fair way from where it was at the start of the year. It's like down 53%, but that's still a decent increase in terms of short-term profit taking from our spread betting clients.
Okay, well let's move on to Purplebricks again. Look, strong year 2017, but I feel there could be a lot of competition for Purplebricks, and that is a concern for me.
It's interesting if you look at up nearly 160% this year, but if you look at this chunk of the chart, a lot of that came in the first half of the year, and since then I think it's down maybe 25% since its 525 highs in August. In terms of its figures, full year figures back in June, its pre-tax profit halved to 6 million, which isn't too bad. Revenue was up 150% to 46.7 million, but it's the kind of company that those figures when it starts to not post those kinds of figures, I guess it's time to start worrying. It's entered the US in the last couple of months, first in Los Angeles, and I think it intends to expand further, California as a whole. Interestingly, that sort of was the main thrust of its growth in the first half of the year was the looming expansion into the US. And since it actually confirmed its launched in the US, it's then sort of lost its way a bit. I think perhaps investors are maybe thinking, has it overstretched itself too early in its tenure? It's also had issues with the advertising standards agency. I think it's been pulled up multiple times on, what you could charitably call, sort of misleading ads, but are likely sort of just lies about the services they're providing. Back in, I think it was in September, its first quarter figures, it did say it was on track to meet full year revenue of 80 million in the UK and 12 million in Australia, which, so that's like 92 million. That is double what it managed back in the full year in June. So again, it's still on track from the revenue side of things. And in the US, it didn't provide a particularly sort of full update of the US. I think that probably has contributed to it falling. But it did say that website visits and I think valuations booked were far higher than at this point in its development than the comparative at the same point in its development in the UK and the US. So it does, along those lines, it seems to be having a positive impact in the US. In November, it sort of issued a 3-line update saying it was on course to meet the board's expectations, which I think sort of the brevity of that update again didn't do it any favours. I think investors are really looking for some kind of further update on the situation in the US. They want to, ideally just some sort of hard figures if it is, website visits or, actual numbers to do with how many website visits they've had or how many valuations they've booked. And I think that is going to be the key on Wednesday, with its half-year report. The figures is likely going to post some pretty strong revenue figures. If it can shrink its pre-tax losses, that's always positive. But I think investors are really looking for some kind of update in the US.
Clients?
Interestingly, our clients really aren't a fan. A bit like you, we've seen a lot of sellers around that 350 to 375 mark. I think, it could stand to lose a bit more in value and it's still going to be up. At least tripled, like 100% this year. I just think, our clients are a bit unsure about it at the moment. I think it's going to take a pretty substantial update on Wednesday to get, looking at just the number of sellers from our clients to get investors back on board, I think.
And finally, Sports Direct, whether you like the stores or not, certainly the shares have done very well this year, off their highs when they initially floated, but then what retailer isn't? Numbers this week, I assume.
Yeah.
Where can it go from here? Is it priced to disappoint, or can Mr. Ashley pull one out of the cheap carrier bag?
It's interesting because before this, it was having a pretty bog standard year. It wasn't really doing a lot at all, and then you can see it's up 38%. This year. That's basically just between, I think, mid-July and mid-August. That's where all of its growth has come from. Before that, it'd basically be flat on the year. Interestingly, I think it was its full year figures in July that sort of sparked that. I think it climbed 40% in the space of a month. Revenue was up 11.7%. That's pretty good. It was up to 3.25 billion. However, pre-tax profit was down 58% to 113.7 million. I think the company just wasn't hedged along, with the pound's slide and really suffered because of that. However, Mike Ashley basically managed to convince investors that the company would deliver 5 to 15% growth in underlying earnings next year, due to the strength of its I think it mentioned this phrase like 10 times in its full-year update, the Selfridges of sports. Its new sort of generation of stores. I think they're set to open 12 to 18 of them in the upcoming year. And they want to have like 75 to 100 of them in the next decade. They're like slightly more upmarket sports stores. I think it was something like the average profit of one of their stores is around £500,000. But the profit of one, I think it was a random selection of these Selfridges, Selfridges of sports stores. The profit was like 2.1 million. So obviously, that's a big increase.
Well, yeah.
It's a savvy move, and obviously it was enough to get investors to ignore that pretty ugly drop in pre-tax profit, and not just ignore it, but fully buy into the idea of Sports Direct slightly changing their sort of tact really in terms of what kind of service they offer. Obviously, since then, it's pulled back a bit from those 420 highs, but not really. It still managed to hold around those levels. Our clients are buying around the 380 mark. I think that, again, they've bought into what Mike Ashley has said. And what will be interesting to see on Thursday is its half-year figures on Thursday, whether whether the sort of the tightening retail sector at the moment, you know, people having less disposable income, inflation and things like that, whether it's moving to the upmarket has come at the wrong time, has that shift sort of seen people squeezed and they'd rather go back to the old cheaper Sports Direct than something a bit more upmarket. I think it also stands, when I think of Sports Direct, I don't think upmarket, and I think of Mike Ashton, I think of sort of scummy deals and you know, poor working practices and things like that. I think the company has a job to do in convincing investors that it moving upmarket, you know, that move is going to stick. Especially since last week you had more, I think it, you know, had to pay out a fine of X amount of millions of pounds, again, for just not paying its employees. So as long as those news issues keep coming out, they really don't show any signs of slowing down, because it seems that the Sports Direct are pretty obstinate in not changing their working practices. I don't know, but then, like I said, investors have bought into the idea that they're shifting up market, and even our clients are buying around the 380 mark. I do think it has a job to do on Thursday to convince investors that this move isn't going to struggle in what is going to be, like we've said, a pretty rocky 2018 for retailers.
Well, let's watch out for that, and maybe watch out for Selfridges announcing that they are the Sports Direct of the luxury goods world. I doubt that will happen, but on that note, Connor Campbell, thank you for joining us.
Thanks very much.